The new jobs report is out, and it appears the U.S. economy is strong. Here to break down what these numbers mean for the stock market is MarketBeat analyst Thomas Hughes. Thomas, start us off with what the report showed Friday morning.
The report was really strong. So the net revisions for the previous month was minus 8,000. But even factoring that in, the headline number was very robust, almost double what the market was expecting. 256,000 aligns with very healthy labor market conditions. Unemployment fell to 4.1%. The participation rate was steady, and wages continue to rise.
Now, all of that sounds like really good news, and yet the market fell in response to this news first thing Friday morning. Why is that?
Right. So this first response is a reaction to the initial news or the initial assessment of the news, which is that healthy labor markets mean that the FOMC is not going to cut rates as fast as the market was hoping. And that aligns with what the FOMC said in their minutes just a few days before that report was released. And that was inflation remains a risk and that they're not going to cut rates as fast as they had been indicating.
Yes, that continued risk of inflation is really, I think, the biggest market concern here. And it shows that the Fed doesn't quite have that dial turned exactly where it needs to be. What are some of the adjustments that could happen?
Well, I think right now they're going to be in wait and see mode. They're very data dependent as always. Right now, the data is saying that inflation remains a problem. So they really have no reason to cut interest rates. I think wait and see is the way for them to go. If the inflation data continues to come out strong, they may have to raise rates later this year.
And that would be very different from what many companies, many investors were kind of expecting. And when things don't go as expected, what does the market do?
It likes to sell off, but really you have to remember this sell off is a repositioning based on a new outlook. And you have to turn to the fundamental conditions to kind of to understand where the market's going to be going from here.
So, what are some of those fundamental conditions? Let's break those down.
So the labor data is scaring the market into thinking the Fed's not going to cut rates because the labor data is strong. Strong labor data is good for the economy, it's good for economic growth, it's good for consumer health and consumer spending, and it's good for corporate profits. So in this scenario, we have some fear of the Fed right now, but the fundamental conditions are still very bullish for stocks.
If some of this discussion about the economy, this jobs report, really anything that has you concerned about where the market might be headed, check out our latest free report. It's called Reduce the Risk, and it's all about how to invest safely in any kind of economic uncertainty. Scan the QR code on the screen right now or click the link in the description of this video to get that free report from marketbeat.com. So, Thomas, does this employment situation report really reveal anything about certain sectors of the market?
The big takeaway from the report, I think, is that the manufacturing sector contracted. But that's been going on for a long time. Sometimes it grows, sometimes it contracts, but it was offset by services growth. And that's been the story for our economy for like 3 or 4 or 5 decades. Manufacturing has been hurting as jobs are going overseas, but the services sector has been growing very strongly, and that's been supporting our economic growth.
Now, let's dive into these stats a little bit and the data that's coming out. It's not all, the most current data. I think that's an important factor for people to remember when they're looking at some of these numbers.
Some people like to look at the labor market data as a leading indicator, but at best, it's a coincident indicator, and it really is kind of a lagging indicator because some of these data points are 2 months old. The JOLTS is 2 months old, it's for November. The Challenger and non-farm payroll report are both for December. So it's rear-looking data. Some of this data is more current. The initial claims data comes out weekly. It's the freshest data we get. And those numbers this week were pretty encouraging. The initial claims fell sharply, and so did total claims. Both numbers are tracking in alignment with strong, healthy labor market trends. And as a point of note, the total claims is now lower than it was last year at this same time, which is the first time all year it's been that way. It's a pretty important shift.
That is a big shift. And what does that shift mean for investors? Where should they look in a market where there's fewer unemployment claims and the jobs market is really strong?
Well, I think this aligns with the outlook for a broader stock market rally. We have healthy consumers. We can expect consumption to continue. As Trump policies come into effect, that rally should broaden as regulatory headwinds ease. So I think that investors could look into a broad array of stocks, look at sectors that are supposed to outperform, but also the small caps and mid caps are supposed to do pretty well this year.
Let's wrap up this discussion with just a look at the S&P 500. January hasn't been a really strong month in the market. Do you expect to see a turnaround with labor data like this, or will this continue to contribute to that little bit of a downturn that we've seen to start off the year?
You're right. January has been kind of weak. It hasn't been aggressively weak, so I see the market really moving more sideways than down. We could experience some more weakness in the near term while the market is repositioning for this new data, this new outlook for the year. But like I said before, the uptrend is still intact, so I would expect this downturn to result in a pretty nice buying opportunity, if not by the end of the month, sometime in the first quarter of the year.
All right, Thomas, thank you so much for the analysis today as we look into the U.S. economy to start out 2025. And thank you for joining us, investors, today. We hope you will check out some of the other content on our channel. Let us know what you want to talk about. Comment, like, subscribe to our channel. We'd love you to join the conversation. Thanks again for watching. And as always, happy investing.